time for part 2 in the modelling methods for inflation. Year-on-year compounding inflation, otherwise known as cost escalation, and we've already got one video, as you may have remembered from a good few years ago, and I'm really sorry, but I've been really busy, so much so that after I had done this video, it was requested that I do the follow-up, the part 2 video, because clearly I had intended to do that. Got really busy and then recognized that I was never going to get it done. So I kind of outsourced it a bit to Josh Wargo, who did this excellent presentation, this webinar. But really, when he did that, he landed the reasons for why you should be doing this, but didn't really spend too much time on the how and showing how to do it, or how to do it in Safran at least. So that's what I'm going to do, is I'm going to kind of complete and bring together what I started, what Josh has done an excellent job of explaining why it's so important, and now I'm going to try and show you a few more examples of how to actually go about doing that. So you can find my original video either here on LinkedIn, or it's actually in the YouTube playlists. It's one of these here. How to model inflation, is that one there. So let's just be clear, a little backtrack and rewind. What was that video? The first video that I did was about a resource loaded schedule. Okay, now in Safran, for those that don't know, you can actually have a CBS, a cost breakdown structure type approach, where you import it via an Excel spreadsheet and then you can map that into the activity schedule as required. So it's a completely different approach. So it needed a different training video. So that's why I knew there was always going to be a part 2 of 2 after that. So I do recommend watching Josh's video first. Then if you're interested in the resource loaded schedule approach, then my original video. And also some of the stuff we're going to be covering today, actually, I've got a whole 2-hour playlist on YouTube again, in the Safran YouTube channel, which is dedicated to explaining how to use the cost breakdown structure method. So it introduces all the buttons and what they do and how to use them. It's a pretty comprehensive training series, and it's completely free. So if you've started watching this video and you're thinking, oh, this could be quite good, but I'm not sure I know enough about Safran, you might want to go and watch that training series first before coming and getting involved in this stuff. This is going to be pretty nuanced, a little complex. I'm going to show some do's and don'ts along the way. So let's get cracking. So I want to start with this example. I want to kind of normalize this theme or concept for you. And I found this image off the internet, NASDAQ performance over the past 10 years. So go back 2015 here, they had plus 22%, then the following year they had plus 10%. And it goes up and down. That's quite a significant drop. There's a massive increase 2019. And then I guess that was COVID years. But look what's going on. And then there's even a negative year here. But if you take all 10 years together and average them out, they have a compounded annual growth rate, a CAGR, C-A-G-R, of 17.4%. And that's going to be a useful concept to use and deploy when we're thinking about some of these things. Certainly when you look at Josh's method, he did deploy this style. And I'm going to show you why he chose to do that, frankly, even though there are other ways. So I put this little chart together in an Excel just in case the CAGR method doesn't really compute, doesn't make sense. Essentially, all you're putting in is choose a value, say 9% in this case. So year 0, your $100 is going to be 109 a year later, if it was like saving, accruing interest in the bank account perhaps, and then another 9%, and then another 9%, and so that's your compound interest growing year on year without even adding any extra money into the bank account. That is just going to be worth 10 years later $237, because you're picking up 9% on what the sum total was in the account on the previous year each time. So it just grows and grows. So I'm not sure that's exponential, but it is certainly going up faster. Right, so Safran, and by the way, let me know if you like or dislike this method. Normally I use slideshows, but I thought I'd give a whiteboard a go for explaining some of these concepts. So I've got a bunch of screenshots here from Safran. I will be jumping into the actual software, the live software as well, but I just thought I'd give this a go and see how it is. So starting here, right. We're actually going to start on the risk register, so the project risks tab of Safran Risk. I've dropped a risk in there, and I've given it 100% chance of occurrence, so it's always going to be used in every iteration. Now, the impact of this item, we're going to use a discrete distribution type, and what I'm going to do here is have a schedule impact where there's 20% chance that there's no additional increase in duration, 20% chance it pushes out the activity by a year, 20% chance by 2 years, 3 years, and 4 years. So you've got this kind of fairly evenly distributed shape here shown. And what I can do is I can show that the mapping is to activity A, the preceding contractor handover. So in this example, we're going to have some procurement, which is activity B, the bulk procurement, and then before the procurement can happen, there's some preceding activities. So in this case, it's consents, it's governance, it's these kinds of things. So that's going to be toggled on to via the risk mapping screen. And that just also confirms the shape of the distribution that you've just seen before. It's going to be affecting activity A. Now, activity A, if we just go over to the next screenshot. So you can see here, this is the actual schedule. So we've got activities A, B, and then this ET, which I'm calling the escalation trigger. That's going to be a useful milestone so we can actually compute and calculate things from a little later. So what you can see here is that we've got a 100-day duration activity for our actual works, but the preceding contractor handover is actually 0 days duration. So that's just going to sit there, and then sometimes it's going to inherit a risk distribution or a duration, sorry, based on the risk distribution from the risk register. If I zoom that out, you can see that what we're going to go to now is just follow that blue arrow down there, and I've got that ET, that escalation trigger. It's got a hard constraint. It's got a must start on the 1st of January 2025. So that's fixed in place. So that little orange flag is that thing there. And that's going to be used, as I said, for part of the calculations. The cost module is just found here on the black ribbon for any of those people that decided not to go and watch any of the actual explanatory training videos. And in the cost module, you'll be able to pump in all kinds of different variables, such as an inflation rate, and have that as a standalone variable that is then picked up as a reference in other formulas. And the formulas that we're going to be using in this cost module, you can learn a little bit about it in the user guide, of course. So there's some similarities to Excel, some similarities to JavaScript. So there's a little nuance. There's things like square brackets versus curved brackets, parentheses, that might catch you out when you're drafting some of the formulas. But essentially, you can see that there are mins, there are maxes, there are if statements. So there are things that are going to be fairly familiar to people. But I recommend reading the user guide to catch up on the various different forms and types. And then if we go into the cost module, I'll just have a look at this now. So in this example, I've got an original cost of say $100. And then in a different node, I'm going to expand that to show my workings out for the cost escalation. So the compounded annual growth rate, or the CAGR, I'm not sure how you pronounce that acronym, but CAGR works for me. We're going to be doing it on activity B that you might remember from the schedule. So this was the bulk procurement. And I'm going to use a method here where we're going to be trying to figure out how long has this thing been delayed into the future. So we're going to need to run some observations, live observations on an iteration by iteration basis to pick that up. And we are going to just drop down here. So you can see that you can build these formulas, as I mentioned earlier, that will say, well, look, let's look at the escalation trigger, and that can now be used as a reference point in the calculations. And you can see that my ET, I've given it a symbol here, so days, ET, early start date, so that's already in the formula now. And then I'm counting the days between 2 points. So I've got my ET, my escalation trigger, then the actual early start of activity B. So activity B gets pushed out by the risk simulation, and then whatever that value is, divide it by 365, and then that's going to give us a clue as to how many years have gone into the future, or this activity has gone into the future. So you plan to start this year in 2025, but actually it gets delayed, and so it might happen or not happen because of consents and governance for another couple of years or 3 years or whatever it might be. So that is the method that we're using to figure out how many years of worth of inflation we're going to need. And the rest of this formula then, let's just have a think about that. So activity B has a cost, which is $100. So I've got my cost here, and then I'm going to multiply that against the inflation rate, which is to the power of however many years of inflation have been observed. So I'm going to need an inflation calculation, which you saw me using a method back at the top there, which was the variables table. There was a little screenshot over here. So just to show that again, the inflation rate, I'm using a beta per, and I'm just going to assume that there's going to be at least 4% inflation. It could be negative, it could be de-inflation or disinflation, whatever, deflation, that's the word I'm looking for, third time lucky. So we're going to have deflation of potentially -1%, but it's probably going to be 4%. It may even be as high as 10%. So that's the Monte Carlo random sampling that will happen on that distribution. And then we pick that up down here on the variables from the variables table. So that goes in there. So we've got our cost is 100. The inflation, deterministically speaking, should be 4%, but it may be more or less. And then we need to multiply that by the number of years, which, as I've shown, is detected by that calculation there in the green box. So because I'm going to be able to share this whiteboard, you'll be able to pick up this address and then come here and copy and paste these formulas if you want to. You can sort of double click this and Control C and paste it out. So you've got access to that. I'm actually going to share the files anyway, so you won't really need to do it that way around. But what we're going to do next, run the simulation. If you've been trained on Safran, you will know that it's found here under the Analyze screen. So we're going to trigger that simulation, and then you'll see all of these dates moving around. So activity A, which had 0 duration, is now inheriting from the risk. Do you remember there was a 20% discrete chance it would be 0, 20% 1 year, 20% 2 years, and so forth. So that is pushing that activity out loads into 2028. So you've got about 3 years worth of inflation now to calculate for something that we're going to procure not until the year 2028. We were hoping to do it this year, but we're delayed 3 years. So that's going to fundamentally change the costs of the project. Imagine it was steel or something like that. So results. Distribution graph on the results. Now you can click onto activity A, B, etc., and you can see information on those things. But look, first of all, we're just looking at the schedule impact on A. So this is where the risk was mapped. And look, there's that 20%, 20%, 20%, 20% chance. So you've got your 5 possible outcomes. So that is showing us that that part of it at least is working correctly. And you can even see over here on the statistics on the right hand side here, the deterministic date was this, the probability is 20%, so it's exactly what I'm expecting, right? Now if we just pop down, I've got an example of when you click on the costs, because this is what we were doing, is the cost module. And in here we can see, we can go down and click on our activity B with the escalated costs. So there's an example of that. So that first bar here, where it's like 700 iterations, that was the mode. So the most adopted was 100. In fact, you can see that there on the statistics, mode 100. So that happens most of the time, was the most likely outcome. So this is at cost of activity B. But you can see that from the axis, it has the potential to increase or inflate over time. So you can have this compounded situation where you might have anywhere up to 10% compounding year on year up for a number of 4 or 5 years. So that 100 becomes potentially 140, 150-ish over time, although that's statistically unlikely given the number of iterations that we ran. So most likely is going to be somewhere down in this region, which is great. And so we're liking that we're seeing that that's cheaper. And we can see probably the P50 here is about 106. So we're expecting up to half of the iterations to be 6% inflation. But it could go much higher. And our confidence say P70, P80, you're in the 12 and 15% inflation. So let's move this along a bit. Now I quite like using the scatter plot because it actually helps show that this is working as expected, because I've got my cost and my schedule shown side by side. So I've got my inflated costs here. So we've got 100, which represents the original base case here. And then you've got your delayed by a year, 2 years, 3 years, 4 years. And we can see that the green sort of tip goes below 100. So that's when sometimes there was 1% deflation compounding year on year. And then at the other end of the scale, if we go to the top of the pink, you get the potential for about 10% inflation year on year at the extreme of the range. So we can see that what we set up is actually working quite nicely as intended. So that's good to see. Now, if you want to try and have a play along in here, you can download from this link here. So again, just I'll send and share that out. So you can click on that. I'm sharing it on my SharePoint. There's 2 files that you're going to need from there. One is the SPX, that's the schedule file. The other one's the risk model file. Get those both into your Safran Risk. So import the Safran project file first, and then import your risk model. That will pair together the activity schedule alongside the risk model. So I don't know if you found that super confusing, but I just wanted to give it a go to see if I could explain things using a whiteboard instead of slides. Now what I propose doing is dropping into the live software and showing you a completely alternative method. What I've shown there broadly aligns with what Josh was doing, Josh Wargo, in his video. So he showed towards the end, he kind of flashed it up on the screen, a formula which was very similar to the one that I was using here. And I kind of retro engineered that for this model just to sort of test out the way that he had approached it. And what he's effectively doing with this power law type approach is or what we are doing, because he's done it and now I've done it, what we're doing is reducing the complexity. So the advantage of the way that we've just shown it done there is that you can take a value, say 10%, and say it's always going to be 10% every year. And that is very or exactly the same as what we've just done here with an Excel spreadsheet, where we just said, well, look, be 9% every year, year on year, and you can just very quickly extrapolate that one out in a linear fashion. So that actually has parity with the method that I showed in the original video from one of two, and that was the method with the resource loaded schedule, of course. Now, the good thing about that is it's relatively simple to put together. I know that may have seemed a bit confusing, but this is why I'm sharing the files, so you can actually poke around and play and explore for yourself and figure it out, right? If you are sat there thinking, but Chris, it could be up one year and down the next year, and you might have gains that are then eradicated by subsequent years, you might have massive deflation or something, in year 3, which eliminates or wipes out the gains in years 1 and 2. Well, that's a perfectly reasonable question, and yes, it is possible to do that in Safran as well. However, as I'm about to show you, in this model here, is it this model? Nope, not this model. As I'm about to show you in a different model, it's much more difficult. It's going to take you a lot more time to do. This model, however, is just showing you the same ideas that we've just been looking at a moment ago on the whiteboard. But this time I'm using a slightly amended method where I'm again using this chap here, the escalation trigger. So he's in my schedule there, and he is going to create a hammock activity. So if I click on 0200, that's my countdown to procurement. So this is going to help us visualize and see how much time has elapsed from the point at which we thought we were going to be procuring materials to the point that we actually end up procuring materials. And then that's going to be the thing that we use in our escalation calculation. So let's just run that, and then you'll see that happening. So we've got 559.7 weeks there, and then depending on the risk analysis, the QSRA is going to stress that schedule network, and some things become critical and other times non-critical, near critical, etc. But importantly, this orange bar is going from years 1, 2, 3, 4, 5, 6. You can see that across the top here. So that is going to be used to measure or do the power law thing against multiply how many years worth of inflation is there. I'll just hit complete on that. And so in this project, and I'll not do a deeper dive on this project some other time, but I'm doing an offshore wind farm. There's a project execution phase, then there's an operations phase, and then there's a decommissioning phase. I've not finished really building this model out just yet, so that's why it's not ready to show off in full. But hopefully I'll be able to show some break-even points, so some tests for have we actually recovered the money yet from our operations phase based on how much did it cost during the execution phase. But that's for another webinar, that's for another time. So let's ignore that. Let's concentrate instead on the inflation. So we've got inflated cost of the strike price. There's, I believe, construction. Let's keep this simple. Let's just look at the steel involved in building these offshore wind turbines. So we've got steel inflation. So we've got a value that's being modelled here. So it could be as low as sort of 2 or 1%. Minimum there is 1% inflation. It might be as high as 22, 23% on the maximum. So that is what we're going to be using, and then we'll power or multiply against that against the number of years delayed. So first of all, my number of days, that is the what the hammock was measuring, and then we're going to divide that by 365. That will give us the number of years. So this is going to be used in the calculation. The actual cost of steel, cost per metric ton of steel is going to be 500. Is going to be our base point, starting point, and so we're going to inflate that year on year by whatever was modelled. So we click on steel inflation CAGR. So that 500 is going to go up by potentially 1.5 times, 2 times, 2.5 times over the course of this model. And we can see go into that outturn, construction costs. Let's go to say our onshore. So when you click on the steel that's involved in the cables or the monopiles, you can see that this thing is going up in line with that inflated cost. And it all follows that same distribution, that same shape. Now, of course, it's possible to add in other risk events and things like that that might change the cost of steel, but inflation is the thing that we're modelling in this example, really, primarily. So there you go. There's just some ideas, some inspiration for that, and just so you can see it on the cost model, because I did do this slightly differently from the whiteboard method. We've got number of days to procurement, 879, picked up from that hammock, which is down here. So that's square brackets, very important. Use that symbol there in this case, days to procurement dot duration. So I'm going to pick up the duration, 879 days. And then if we were to just run that analysis again, you'll see that that value, click on the cost model now this time, number of days to procurement, 1,117, 1,363, 1,086. So this will change with every iteration. So we now, the next part of that is to then divide it by 365. So years to procurement divided by 365 in the formula, that's the number of years, and therefore that's going to be the thing that we use to multiply the inflation year on year, or the CAGR. So the CAGR is 1.28, and there's the value of the steel. And then that can then get picked up here in the actual project execution phase of the costs. Let's go to the offshore steel cables. So unit price is going to be the MTS, which is the cost per metric ton of steel multiplied by the CAGR. So there you are. And if I click, 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 you can see that that then changes, and all the values change as appropriate. In this particular case, if you're wondering what's the 100 got to do with anything, that's the number of towers, that's the scope of the project. So I'm going to build 100 of these wind turbines. But anyway, we'll go into that another day. So what I wanted to really get to, though, was not this model, it was the other one. So let's look at the non-linear. So everything that we've done so far with the power, i.e. the number of years, multiply the CAGR by the number of years, that method there is linear. This method is non-linear. Now, I'm deliberately making this an even smaller project. So I've got activities A, B, and C. Very simple. Activity A has to finish start into B and then C. And these guys each have a duration of just 100 days each, and they are going to be pushed around by a quick risk that I've added into the risk register here, and that is just going to give me some percentage increases to shove this schedule around, bully it around a bit. And let's just show that off. There we are. So we can see that that is being moved around quite a lot. Okay. So the actual durations for each, you'll see that 314, 314, 314. I've not done anything terribly clever here. It's just they're all short or long. And that's going to change where in time they finish and where in time that certain values that you might be procuring or thinking you're procuring this year, if you're not doing it for another few years, then obviously that's going to inflate. So, right. Okay, so in this cost model, let me just shrink everything down a minute. So we've got three top nodes. I've got the baseline of the project, the escalated project cost, and then the place where we actually run the calculations, which are separate from those nodes there, but are going to be used as part of the reference in order to create the escalated baseline. So if we expand that, activities A, B, and C, each $100 cost each, and there's literally nothing special happening in there. Then escalated costs, is going to be the product of the calculations. So it is referencing the original cost of project A, or it could be project A or activity A, which way you want to think of it. And then we've got the costs of A been done in the year 2024, 2025, 26, 27, 28. And then you've got a very similar setup in here and here. So they're referencing these C24, 25s down here in the calculations section. So let's just do that. So we open up 2024. So let's just take stock of which year. Okay, so these are starting in the year beginning of 2023 in this example. So slightly different from what we were looking at before. So if those if those activities stray into the following financial year or the following calendar year, 2024 in this case, then it's going to increase some cost by the inflation rate. And that's on activities A, B, and C. Now, activity C is already knowing from its if statement, if activity C's early finish greater than the end of 2023 date, then use C costs, otherwise use 0. So that's the formula I'm using in these ones for A, B, and C. And of course, activity C or project C knows that it is going to be occurring in 2024. If we expand into 2025, 26, 27, it's the same thing, but what we're doing each year, we're just adding to that same formula. It's just an if statement, just to check, does this thing occur or finish within the next year? So we go 25, does it go into 26? As in, does it go beyond the end of 2025? It therefore must be in 2026, and so forth. So these if statements just grow and grow until I've got to the end of my project, where it's the worst case I can imagine it's going to land is in the year 2028. So I'm going to have to do this test, this if statement test, and then backfill, or it's not backfill, but reference back to each of the previous years in order to pick up the inflation rate, given that the inflation will have been different on each year. Now, this is a more precise way of doing it, a more air quotes accurate way of doing it, but I'm hoping that you can sort of see the problem that if you don't know how many years into the future this thing goes, you're going to have to keep manually recreating and adding an extra bit of formula for everything you wish to inflate. And that basically sounds like a lot of effort to me. It took me a while just to build this model with simple project A, B, and C, going into just like 4 or 5 years worth into the future. I mean, I'll run the analysis just so you can get a feel for what's happening here, but there you are, there's the activities moving around. Here are the costs, sometimes applying and sometimes not applying because of the if statement, so sometimes zeros and sometimes not zeros, right? So, and that will be shown quite nicely in a moment on the distribution graphs. So we can click into any given activity on any given year, and we will be able to see what the spread of outcomes looks like for that. And then, of course, pick up the inflation if that's what, of course, we were here to do in the first place. So if you click on base project, that's just going to be a big ugly square because there's been no movement on the original base case. It's only when you get into the escalated project that you actually see what this thing looks like. So remember, the projects A, B, C, 3 projects, each $100 each. So the deterministic says it's 304, so I must have slipped in an extra few dollars there somewhere along the way. But here is the distribution that we're expecting. So what's the probability of it being $300 or $304 in this case? 16, P16, not great. What's the chance that it will be no more than 10% inflated, say? And you can get a sense that that's going to be around about P45. Of course, you could set a target asked that question specifically. What is it going to be for 310? So that's added that in. So the target P10 probability 43. Okay, so P43. I was just off by a couple of percentage points there. Project A, what are your escalated costs? So the fundamentals here are quite different because Project A is the first one that occurs. So the chances of it falling into a subsequent year are the lower, um, or are lower compared to projects B and C, which have to follow on with the finish start relationship. So when we click onto project B escalated costs, now you've got a spike for all those times that project A finished within its financial year, increasing the odds that B is also going to finish within its planned financial year, and we're not going to have the inflation to calculate there. But then this sort of nice shape here is the distribution of the compounding inflation year on year, the CAGR for B, and then when we get to C, you don't get anything that is, well, it's very difficult to stick around the 100, but you've got the potential to go up as high as 130, 140, whereas Project A was only up to about 10%, 9%, 10%. In fact, where's the max? Yeah, 110%. So I hope that gives you some sense of, why you would or wouldn't want to choose one method over the other. I mean, this is just interesting, right? Sorry, I'm baffled. There's A, B, C in the year 2024. So asking a slightly different question, get different answers. But yeah, this is great insights, but the amount of time it would take you to build this model specifically in this way and then program it with all the if statements, it's going to take you a while. So I'm not sure I'd recommend doing it this way, but it is possible to do it this way. Maybe there's a feature request in this where you just get Safran software to developers to put in a an inflation calculation, so it's just all handled by the user interface, so you don't have to go do this. But at the moment, my recommendation would probably be use the method that Josh Wargo showed in his video. Go watch his video because it was just really good explaining why you should be doing this, because of course I think in his examples, if things are going to be inflated in orders of magnitude year on year compounding, and you've got particularly long projects or mega projects into the future, then the original case that was sanctioned by government or whoever the owning organization is, can be quickly watered down in terms of return on investment if these kinds of concepts have not been thought about, right? So that's why it's so important. But go watch Josh's video. He does a wonderful job of explaining that in some detail with examples. Yeah, so there we are. I think I'm going to end the video here. But as I said, I will be sharing the files. You'll be able to find them on the whiteboard here. You'll be able to click on that and go. If I click it here, it will take me, and you'll be able to go and download those, right? So I hope that was useful to you. Let us know if there's any questions on any of this, and do feedback if there's a strong sense that we should do things differently, or tell me if you think there's a different way of doing it. Maybe I'm a complete idiot and I haven't found a smarter way of doing it, which was dynamic, where each year is giving you a different return year on year dynamically. But otherwise, I think for now it seems that the easiest way to do this is using the power multiplication method, and doing it in a sort of linear sense. Cool. Okay. Thanks very much, guys. Bye.